I need to tell you about a crisis that's unfolding right now in the American banking system. A crisis so serious that it could make the 2008 financial collapse look like a warm-up act. And here's what's truly alarming. Almost nobody is talking about it. The financial media is focused on artificial intelligence stocks and Federal Reserve interest rate decisions. Politicians are arguing about everything except this. Even most banking analysts are downplaying the severity of what's happening. But I've been studying banks for over 70 years. I understand how banks work, how they fail, and what the warning signs look like. And I'm telling you, the warning signs are flashing red right now. We're not talking about one or two troubled banks. We're talking about systemic problems affecting hundreds of institutions holding trillions of dollars in assets. Today, I'm going to explain exactly what's happening in the banking system, why it's so dangerous, why almost nobody is paying attention, and what it means for your money. Because if you have deposits in a bank, if you own bank stocks, if you depend on credit from banks, you need to understand that the ground is shifting beneath your feet, and most people won't realize it until it's too late. Let me start by explaining what happened in March of 2023, because that was just the opening act of a much larger drama. Silicon Valley Bank, the 16th largest bank in America, collapsed in a matter of days. It was the second largest bank failure in U.S. history. Signature Bank failed the same weekend. First Republic Bank failed a few weeks later despite a $30 billion rescue attempt by major banks. 3 significant bank failures in 2 months. And the common narrative was that these were isolated cases, poorly managed banks with concentrated risk in technology, startups, and cryptocurrency. The regulators and politicians told everyone the problem was contained. The system was sound, nothing to worry about. But that narrative is dangerously wrong. Those 3 banks didn't fail because of bad management alone. They failed because of a fundamental problem affecting the entire banking system, a problem that hasn't been fixed and has actually gotten worse. Let me explain what really happened. When the Federal Reserve held interest rates near zero for over a decade after the 2008 crisis, and then again during COVID, banks did what banks always do in that environment. They took deposits from customers and invested heavily in long-term bonds and mortgage-backed securities that were paying higher rates than short-term securities. This is normal bank behavior, trying to earn a spread between what they pay depositors and what they earn on assets. Silicon Valley Bank, for example, had over $120 billion invested in long-term securities. Most of these were treasury bonds and agency mortgage-backed securities, supposedly the safest investments available. But here's the problem. The banking regulations obscure. Those bonds were bought when interest rates were near zero. 10-year treasury bonds were yielding around 1%. Mortgage-backed securities were yielding 2 to 3%. Banks loaded up on these securities because they seemed safe and they paid more than cash. Then the Federal Reserve started raising interest rates aggressively in 2022. When interest rates rise, the market value of existing bonds falls. It's an iron law of fixed income investing. If you own a bond paying 1% and new bonds are paying 5%, nobody wants your 1% bond at face value. Your bond's price must fall until its yield matches current rates. A 10-year treasury bond bought at par when rates were 1% is now worth only about 75 cents on the dollar with rates at 5%. That's a 25% loss. Silicon Valley Bank had huge unrealized losses on its bond portfolio. The bonds were still paying interest and would mature at par eventually, but the market value had collapsed. Under accounting rules, banks don't have to recognize these losses immediately if they classify the securities as held to maturity. They can carry them at amortized cost, essentially pretending the losses don't exist as long as they plan to hold the bonds until maturity. Silicon Valley Bank had $15 billion in unrealized losses that weren't showing up in their reported equity capital. Everything was fine until depositors started withdrawing money. When a bank faces withdrawals, it needs cash. If it doesn't have enough cash on hand, it has to sell securities. When Silicon Valley Bank started selling its bond portfolio to meet withdrawals, it had to recognize the losses. Suddenly, $15 billion in hidden losses became real. Their capital was wiped out, and they were insolvent. It happened in 48 hours. The classic bank run, but triggered by bond losses rather than loan defaults. Now, here's why this matters for the entire banking system. Silicon Valley Bank wasn't unique. The FDIC estimates that U.S. banks collectively hold over $600 billion in unrealized losses on securities. $600 billion. These losses aren't recognized on balance sheets because of the accounting rules I mentioned, but they're real. Every bank that bought bonds when rates were low is sitting on losses now that rates are high. And if depositors start withdrawing money, banks have to sell securities and recognize those losses, which can quickly lead to insolvency. But it gets worse. The $600 billion number is only the securities losses. It doesn't include what's happening in loan portfolios, and that's where the really serious problems are developing. Let me walk you through the different types of loans and why each category is facing severe stress. Start with commercial real estate. And this is the big one that terrifies me. Banks hold approximately $3 trillion in commercial real estate loans. Office buildings, retail properties, apartment complexes, hotels, all financed with bank loans. The office sector is in crisis. Occupancy rates in major cities are down 30 to 50% from pre-COVID levels because of remote work. Companies that used to lease 10 floors now lease 4. Buildings that were 90% occupied are now 50% occupied. The rental income has collapsed, but the mortgage payments haven't changed. Here's a specific example. A 20-story office building in San Francisco was worth $200 million in 2019 when it was fully leased. It has a $150 million mortgage, but now it's 40% vacant. The rental income is only enough to cover half the mortgage payment. The building is in default. The bank could foreclose and sell the building, but to whom? Who wants to buy a half-empty office building? Maybe the building sells for $80 million. The bank loaned $150 million and recovers $80 million. That's a $70 million loss on one loan. Now, multiply this across thousands of office buildings in cities nationwide. Banks are facing hundreds of billions in potential losses on commercial real estate loans. And it's not just offices. Retail properties are struggling with e-commerce competition. Hotels in some markets haven't recovered to pre-COVID performance. Even multifamily apartment buildings are facing challenges as new supply hits the market and affordability constraints limit rent growth. The really dangerous part is the refinancing wall. Many commercial real estate loans were made 5 to 10 years ago when interest rates were 2 to 3%. These loans are maturing now and need to be refinanced. But current interest rates are 6 to 7% for commercial real estate. Property owners can't afford to refinance at double or triple the previous interest rate. The cash flow doesn't support it. So they default, the loans go bad, the banks take losses. Regional banks are particularly exposed. Small and mid-sized banks did most of the commercial real estate lending. The large money center banks, like J.P. Morgan and Bank of America, have some exposure, but it's a smaller percentage of their overall balance sheets. Regional banks like Truist, Regions Financial, Fifth Third, KeyCorp, and dozens of others have 20 to 30% or more of their loan portfolios in commercial real estate. When those loans start defaulting in significant numbers, these banks face potential insolvency. But commercial real estate isn't the only problem in bank loan portfolios. Consumer loans are deteriorating. Credit card delinquencies are rising. Auto loan delinquencies are at the highest level since 2008. Personal loan defaults are climbing. Why? Because consumers are tapped out. They spent their COVID savings. They took on debt during the past few years of inflation. Real wages haven't kept pace with inflation for most workers. Credit card balances are at record highs, over $1 trillion. And with credit card interest rates now averaging over 20% due to the Fed's rate hikes, many borrowers simply can't keep up with payments. Auto loans are particularly concerning. The average new car price is over $48,000. The average monthly payment is over $700. Car buyers have stretched themselves thin with long-term loans of 6 or 7 years at high interest rates. As these cars depreciate and borrowers face financial stress, many are going underwater on their loans and defaulting. Banks and auto finance companies are repossessing vehicles at increasing rates, but they're recovering less than the loan balance because used car prices have fallen from their COVID peaks. Corporate loans are also showing stress. Companies that borrowed heavily when rates were near zero are now facing refinancing at much higher rates. High-yield corporate bonds are seeing rising default rates. Companies with weak business models that were kept alive by cheap credit are failing. Banks that made loans to these companies are taking losses. And it's not just small companies. Some larger, well-known companies with too much debt are facing serious financial distress. The residential mortgage portfolio is relatively healthy compared to commercial and consumer loans, but even there, problems are emerging. Mortgage delinquencies are low overall, but they're rising in certain segments. Adjustable rate mortgages that are resetting at higher rates are seeing increased delinquencies. Some markets that saw huge price appreciation during COVID, like Boise, Austin, and parts of Florida, are seeing price corrections, and homeowners who bought at the peak with minimal down payments are going underwater. So you have securities portfolios with $600 billion in unrealized losses, commercial real estate loans facing hundreds of billions in potential defaults, consumer loans deteriorating, corporate loans under stress, and even some weakness in residential mortgages. This is system-wide fragility, not isolated problems in a few banks. And here's why it's so dangerous. Banks operate with very little capital relative to their assets. Banking is a leveraged business. A typical bank might have $10 in capital supporting $100 in assets. That's 10-to-1 leverage. If the bank loses more than 10% of its asset value, it's insolvent. Given the losses I've described, many banks are closer to insolvency than their financial statements suggest. Remember, the unrealized securities losses aren't reflected in regulatory capital ratios. The loan loss reserves banks have set aside are based on management estimates that are almost always too optimistic. Banks don't want to recognize problems until they absolutely have to. So the reported capital ratios overstate the true financial strength of the banking system. Now let me explain why this isn't being talked about more widely. First, banks have every incentive to downplay problems. Acknowledging that you're sitting on large losses and bad loans triggers depositor panic. Banks live and die by confidence. If depositors believe the bank is in trouble, they withdraw their money. The bank has to sell assets at losses to meet withdrawals, and the bank fails. It's a self-fulfilling prophecy. So banks minimize, delay recognition of losses, and hope they can earn their way out of the problems over time. Second, regulators don't want to trigger panic either. The FDIC, the Federal Reserve, the Office of the Comptroller of the Currency, they all know about the problems I'm describing. But publicly acknowledging a system-wide banking crisis would potentially cause runs on multiple banks simultaneously. So they emphasize stability, claim the system is sound, and intervene quietly when individual banks get into trouble. It's a delicate balancing act, trying to manage problems without creating panic. Third, the accounting rules I mentioned allow banks to hide problems. Unrealized securities losses don't have to be recognized if bonds are classified as held to maturity. Loan loss reserves are based on bank estimates rather than rigorous independent assessment. Banks can pretend everything is fine for quite a while before reality forces recognition of losses. This regulatory forbearance is intentional, designed to give banks time to work through problems, but it also means that the true health of the banking system is obscured. Fourth, the financial media is largely focused on other topics. Banking is boring to most people. Technology stocks, cryptocurrency, artificial intelligence, these are the exciting stories that generate clicks and views. A complex story about unrealized bond losses and commercial real estate loan problems doesn't capture attention the way a story about Nvidia or Bitcoin does. So even though the banking crisis is potentially much more important to the average person than whether AI stocks go up or down, it gets minimal coverage. But here's why you should care deeply about this, even if you don't own bank stocks. If the banking system is in trouble, it affects everything. Banks provide the credit that businesses need to operate and expand. They provide the mortgages that people need to buy homes. They provide the auto loans, credit cards, and personal loans that support consumer spending. If banks are weakened and have to pull back on lending to preserve capital, credit tightens, economic activity slows, and recession becomes much more likely. More immediately, if you have deposits in a bank beyond the FDIC insurance limit of $250,000 per depositor per institution, you have direct exposure to bank failures. Silicon Valley Bank had billions in uninsured deposits. When it failed, depositors above the insurance limit faced potential losses. The government ultimately made all depositors whole, but that was an emergency decision that may not be repeated in future failures. If your bank fails and you have $1 million on deposit, you could lose $750,000, everything above the insured amount. Even if your deposits are under the insurance limit, bank failures create disruption. Your money might be frozen for days or weeks while the FDIC takes over and transfers accounts to a healthy institution. You can't access cash, can't pay bills, can't conduct normal business. It's chaotic and stressful, even if you ultimately don't lose money. Now, let me tell you what I'm doing in response to this banking crisis. First, I've been extremely selective about bank stocks. Berkshire owns Bank of America, and we've actually trimmed that position over the past year. We sold significant stakes in several other banks. I'm not comfortable owning most regional banks given their commercial real estate exposure. I'm focused on the largest, most diversified banks with stronger capital positions, but even there I'm cautious. Banking at current valuations with these risks doesn't excite me. Second, I keep Berkshire's cash in short-term treasury bills rather than bank deposits where possible. Treasury bills are direct obligations of the U.S. government with zero credit risk. They're far safer than bank deposits. For the amounts Berkshire deals with, hundreds of billions of dollars, we can't rely on FDIC insurance. We need absolute safety, and Treasury bills provide that. Third, I've been looking at banks as potential acquisition targets. If this crisis deepens and some banks get into serious trouble, there may be opportunities to acquire banks or bank assets at distressed prices. The FDIC often looks for strong institutions to take over failed banks. Berkshire has the capital and expertise to do this, and history shows that buying banks during crises can be extremely profitable. We made good money acquiring failed bank assets during the savings and loan crisis in the 1980s and 90s. Fourth, I'm prepared for economic weakness resulting from banking system problems. If banks pull back on lending, consumer and business spending will slow. This affects our operating businesses. We're managing inventories carefully, controlling costs, and maintaining strong balance sheets at all our subsidiaries. Financial strength becomes even more important when credit conditions tighten. Now, let me give you specific advice for protecting yourself. First, if you have deposits above $250,000 in any single bank, spread them across multiple institutions to stay under the insurance limit at each bank. Yes, it's inconvenient to manage multiple bank relationships, but it's a lot less inconvenient than losing your money when a bank fails. $250,000 per depositor per institution is the limit. If you're married, you can structure accounts to get higher coverage, but be careful about the rules. Second, choose your bank carefully. Not all banks are equally risky. Look for banks with strong capital ratios, low exposure to commercial real estate, diversified loan portfolios, and conservative management. The largest banks, J.P. Morgan Chase, Bank of America, Wells Fargo, Citigroup, are generally safer than regional banks because they're more diversified and face more regulatory scrutiny. That doesn't mean they can't fail, but the probability is lower. Third, consider keeping some of your cash in treasury bills or money market funds that invest in treasuries rather than in bank deposits. You can buy treasury bills directly through Treasury Direct, the government website. They're paying around 4 to 5% currently and have zero credit risk. Money market funds that invest exclusively in treasury securities are also safe and provide liquidity. Fourth, if you own bank stocks, look very carefully at commercial real estate exposure. Any bank with more than 20% of its loan portfolio in commercial real estate is high risk, in my opinion. Look at the specific types of commercial real estate. Office exposure is much riskier than multifamily residential. Look at geographic concentration. Banks heavily exposed to troubled office markets like San Francisco, New York, and Chicago face more risk than banks in markets with stronger fundamentals. Fifth, watch for warning signs at your bank. If you see news about large deposit outflows, management changes, regulatory actions, or credit rating downgrades, pay attention. These can be early indicators of trouble. Check your bank's financial statements if you're capable of reading them. Look at the unrealized losses on securities, the concentration of loan portfolios, and the trajectory of non-performing loans. If problems are accelerating, consider moving your money. Sixth, maintain an emergency fund in cash that you can access immediately. If banking system problems escalate and ATMs go down or accounts get frozen, you need cash on hand to buy groceries, fill your gas tank, and handle immediate needs. Keep several $1,000s in physical cash somewhere secure at home. It seems old-fashioned, but in a banking crisis, cash is king. Let me address the scenario that really worries me, the one that keeps me up at night. What happens if we get a cascading series of bank failures? Here's how it could unfold. Start with more regional banks failing due to commercial real estate losses. As each bank fails, confidence in other banks weakens. Depositors start moving money from smaller regional banks to the largest institutions perceived as too big to fail. This deposit flight forces smaller banks to sell securities at losses and call loans to raise liquidity. The selling drives down securities prices and tightens credit, which worsens the economy, which causes more loan defaults, which creates more bank losses. At some point, the FDIC's Deposit Insurance Fund, which had about $120 billion as of late 2024, gets depleted by covering losses at failed banks. The fund is backed by the full faith and credit of the U.S. government, so technically it can't run out of money. But having to ask Congress for emergency funding creates political drama and further erodes confidence. Meanwhile, credit tightening causes recession, unemployment rises, consumer defaults accelerate, business bankruptcies increase, more banks fail. It feeds on itself. The Federal Reserve would intervene. Of course, they'd create emergency lending facilities to provide liquidity to banks. They might restart quantitative easing to support bond prices and reduce bank securities losses. They might even cut interest rates back to zero. But if they do that, inflation comes roaring back because the underlying fiscal situation hasn't been fixed. So we could get a toxic mix of banking crisis, recession, and renewed inflation. Stagflation with financial crisis on top. That's a nightmare scenario. I'm not predicting this will definitely happen. The government has powerful tools to intervene and stabilize the banking system. They proved that in 2008 and again in March 2023. But the problems are larger now than they were then in many ways. The unrealized securities losses are larger. The commercial real estate problems are more widespread. The fiscal situation is worse, which limits government options. And we've already used many of the policy tools, so there's less ammunition available. What gives me some hope is that the largest banks are in better shape than in 2008. They have more capital, better liquidity, more diversified business models. If the crisis is confined to regional and small banks, it's manageable. The big banks and the government can facilitate mergers and acquisitions to absorb troubled institutions. We could muddle through with damage, but not catastrophe. But if the contagion spreads to larger institutions, if depositor confidence breaks system-wide, if the commercial real estate losses are as large as I fear, then we could face a crisis as severe as 2008 or worse. And that's not speculation. That's a realistic assessment based on the numbers I've shown you. The reason I'm speaking out about this is that I believe people deserve to know the truth about risks they're facing. The banking system is not as stable as authorities are telling you. There are serious systemic problems that have not been resolved and are in some ways getting worse. You need to protect yourself, make sure your deposits are insured, choose strong banks, consider alternatives to bank deposits for some of your money, watch for warning signs, have contingency plans. I've been through banking crises before. The savings and loan crisis of the 80s and early 90s, the Latin American debt crisis of the 80s, the 2008 financial crisis. I understand how these things unfold. And I'm telling you, the warning signs I see today are as serious as any I've seen. This is not the time for complacency. This is the time for caution, for preparation, for making sure you're not the one left holding the bag when confidence breaks and banks start failing in larger numbers. The banking crisis no one is talking about is real. It's developing in slow motion, but it could accelerate quickly if the wrong triggers occur. Protect yourself now while you still have time. Because once depositor panic starts, once bank runs begin, it's too late to move your money. The banks close, accounts freeze, and you're just hoping the government makes you whole. Hope is not a strategy. Preparation is. And if I'm wrong, if the crisis doesn't materialize, the worst that happens is you were slightly inconvenienced by being cautious. But if I'm right and you're not prepared, the consequences could be devastating. That's a risk-reward calculation that seems pretty straightforward to me.